Here is a question that almost nobody in the investing world wants to answer honestly. What is the actual secret behind the greatest wealth ever built by a single individual investor in modern history? Not a hedge fund, not a bank. One person, one framework, 70 years of applying it without wavering. Warren Buffett started with $114. He was 11 years old. He put that money into his first stock, 3 shares of City Service, and spent the next 7 decades compounding it into a fortune that now exceeds $140 billion. He never worked at a bank. He never created a tech company. He never inherited generational wealth. He built it almost entirely through a simple, repeatable process that he has followed every single time, without exception. And here is the part that should stop you in your tracks. That process is not secret. Buffett has explained it publicly, in letters, in interviews, in books, and in speeches at universities around the world for the last 50 years. He has handed the playbook to anyone willing to read it, and yet the overwhelming majority of investors, professional and amateur alike, do not follow it. They know it exists, they have heard of it, and they still don't use it. Why? Because knowing a system and actually trusting it with your money are 2 very different things. Today, we are going to change that. By the end of this video, you will have the complete Buffett checklist, every filter he runs before committing a single dollar to any investment, and more importantly, you will understand why each step exists, what it is protecting you from, and what it costs to skip it. This is not a hype video. This is not a motivational speech. This is the real framework, explained clearly, with the real stories behind each rule. Let's get into it. Before we get into the checklist itself, it's worth spending a moment understanding the philosophy that sits underneath it, because without that context, the individual rules can feel arbitrary. They are not. Every item on this list exists because Buffett learned, usually the hard way, what happens when you skip it. Most people approach investing the same way they approach gambling. They look for a tip. They follow a trend. They watch what other people are doing and assume the crowd has done the research. They buy high because the excitement is high, and they sell low because the fear is high. And then they blame the market. But the market didn't make those decisions. The absence of a system did. Buffett has described his approach as fundamentally different from this in one key way. He is not trying to predict what the market will do tomorrow, or next week, or next year. He is trying to find businesses that are so strong, so durable, and so well managed that even if the market ignored them for a decade, they would still be worth more at the end of it. He is buying businesses, not tickets. That single reframe from buying stocks to buying businesses is the foundation of everything. It changes what you look at, what you ask, what you worry about, and how long you are willing to wait. It is the lens through which every step of the checklist makes sense. Keep it in mind as we walk through each rule. Rule number 1 on the Buffett checklist is deceptively simple, and it is the rule that most people feel confident they are following when they are almost certainly not. The rule is this: never invest in a business you cannot explain clearly, in plain language, to someone who knows nothing about investing. Buffett calls this the circle of competence. The idea is that every person, every investor, every professional, every analyst has a bounded area of genuine understanding. Inside that circle are industries, business models, and companies that you truly grasp. You understand what they do, how they make money, what could hurt them, and what makes them difficult to compete against. Outside that circle are everything else. And outside that circle, according to Buffett, you do not invest. Full stop. This is not a statement about intelligence. It is not saying that only smart people can invest. It is saying that confidence without comprehension is the most expensive mistake in the investing world. You can be a brilliant engineer and still have no business buying shares in a pharmaceutical company whose drug pipeline you cannot read. You can be a doctor with a high income and still have no business investing in a semiconductor company whose supply chain dynamics you've never studied. The circle has nothing to do with how smart you are. It has everything to do with what you actually know. I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. Warren Buffett here is the story most people use to argue against this rule, and here is why they get it exactly backwards. In the late 1990s, at the height of the dot-com boom, Buffett refused to invest in Amazon, Google, or any of the major technology companies reshaping the economy. Critics called him outdated. They said he had lost his edge. They said he didn't understand the new world. His Berkshire Hathaway stock underperformed dramatically relative to the tech-heavy Nasdaq for several years. The headlines were brutal. And then the dot-com bubble collapsed. Trillions of dollars in market value evaporated in under 2 years. Companies that had never earned $1 of profit lost 90, 95, even 100% of their value. Buffett, who had sat out the entire frenzy, lost almost nothing. Not because he had predicted the crash, not because he was smarter than everyone else, but because he had simply refused to buy things he didn't understand. That one discipline applied consistently protected him from one of the worst financial disasters in modern history. It is also worth noting what happened afterward. Buffett eventually did invest in Apple, not as a technology company, but as a consumer products company with extraordinary brand loyalty, a hardware ecosystem that creates deep switching costs, and a customer base that grows more committed over time. By the time he understood the business well enough to be confident in it, Apple had already become one of the most profitable investments in Berkshire's history. He waited until it was inside his circle. Then he moved. Rule number 2 is where Buffett's framework separates itself from almost every other investing philosophy on the planet. It is the concept of the economic moat, a term he coined and popularized, and one that has become so fundamental to value investing that it is now taught in university finance courses around the world. A moat, in the medieval sense, is the wide water channel surrounding a castle that prevents enemies from reaching the walls. In the business sense, a moat is any durable structural advantage that prevents competitors from taking your customers, your market share, or your profits, no matter how hard they try or how much money they throw at it. Buffett is not just asking whether a business is profitable right now. He is asking whether it will still be profitable in 10 years, in 20 years, after competitors have done everything they can to destroy it. He identifies 4 main types of moats. The first is brand power, when a company's name alone carries so much trust and recognition that customers will pay a premium for it without question, and no amount of competitor advertising can displace it. The second is switching costs, when a product or service is so deeply embedded in a customer's workflow, life, or identity that leaving it would be genuinely painful. The third is cost advantages, when a company can produce something so much cheaper than its competitors that it is structurally impossible for anyone to undercut them profitably. And the fourth is network effects, when a product becomes more valuable the more people use it, creating a self-reinforcing cycle that makes the leader almost impossible to displace. The most famous example in Buffett's portfolio is Coca-Cola. He purchased a significant position in 1988 and famously has never sold a single share. To understand why, consider what Coca-Cola actually is. It is not a beverage company in the traditional sense. It is a brand recognized in over 200 countries, including places where clean drinking water is scarce and government infrastructure is non-existent. But where you can walk into a small roadside stall and find a cold Coke. The distribution network is so deep and so global that even multi-billion-dollar competitors have spent decades and billions of dollars trying to challenge it and have largely failed. The formula itself is over 130 years old, and to this day, no competitor has successfully replicated the exact taste profile at scale. That is a moat. That is the kind of business Buffett will wait years and pay a significant premium to own. But here is the nuance that separates real moat analysis from wishful thinking. A moat is not the same as a product advantage. Lots of companies have great products. Great products get copied. Great products get disrupted. A moat is a structural feature of how the business operates in the world, the relationships, the scale, the brand trust, the switching costs that makes it resilient even when products change, markets shift, and new competitors arrive. When you are evaluating an investment, the question is not just whether the product is good. The question is whether the business has built something around the product that cannot easily be dismantled. When Warren Buffett evaluates the management of a company he is considering investing in, he applies a framework he has articulated publicly many times. He looks for three qualities: intelligence, energy, and integrity. And he always adds the same caveat that if the person running the business lacks integrity, the first two qualities will destroy you. Think about what that actually means. A highly intelligent, highly energetic leader without integrity is not just useless, they are actively dangerous. They will find creative ways to mislead you. They will build systems that optimize for their own compensation at the expense of shareholder returns. They will take risks they don't disclose. They will make decisions that look good on short-term earnings reports and look catastrophic on 5-year charts. Buffett learned this lesson early and has never forgotten it. The most vivid illustration in his career came in 1991, when Berkshire Hathaway owned a significant stake in Salomon Brothers, one of the most powerful investment banks on Wall Street. A single trader at the firm had submitted false bids in United States Treasury auctions, a federal offense. When the scandal broke, it threatened to destroy not just the trader's career, but the entire bank. The federal government was considering revoking Salomon's license to operate, which would have effectively ended the firm overnight. Buffett stepped in, personally. He was appointed interim chairman, flew to Washington, testified before Congress, negotiated with regulators, and spent the better part of a year managing a crisis that had nothing to do with the investment he had made and everything to do with the character of a single person the firm had allowed to operate without sufficient oversight. He later reflected that the time, stress, and reputational exposure of that experience was the most costly investment he had ever made, not in dollar terms, but in everything else that matters. So how do you evaluate management integrity as an outside investor when you are not sitting in the boardroom and do not have access to private conversations? Buffett points to several observable signals. The first is the shareholder letter. How does the CEO communicate with shareholders? Do they acknowledge mistakes and explain what went wrong? Or do they spin every setback into a learning opportunity and bury the bad news in footnotes? Honest management sounds honest. The second signal is capital allocation. What does the company do with the money it earns? Does it invest in things that make business sense, or does it chase acquisitions that make the executive team feel important and the press release look impressive? And the third signal is skin in the game. Do the executives own meaningful amounts of company stock purchased with their own money, not granted as compensation, but genuinely purchased? When the people running a company have their own wealth tied to its performance, the incentive structures align with yours. In looking for people to hire, you look for three qualities: integrity, intelligence, and energy. And if they don't have the first, the other two will kill you. Warren Buffett rule number 4 is is the one that tests your patience more than any other. It is easy to understand intellectually and genuinely difficult to follow in practice, because it requires you to do something that goes against almost every emotional instinct you have as a human being. It requires you to wait. Buffett draws a clear and permanent distinction between the price of a business and the value of a business. The price is what the stock market is charging you right now, and the stock market, as he famously noted, is a voting machine in the short term. It reflects sentiment, fear, greed, momentum, news cycles, and the collective emotion of millions of people making decisions in real time. The value is something entirely different. The value of a business is the sum of all the cash it will generate over its lifetime, discounted back to today. It is a mathematical concept grounded in fundamentals, not feelings. These two numbers, price and value, are almost never the same. Sometimes the market overvalues a business, pricing it as though everything will go perfectly for the next 30 years. Sometimes the market undervalues a business, pricing it as though it is about to collapse when the underlying fundamentals remain strong. Buffett's entire strategy, the strategy that has produced over 20% annual returns for half a century, is built on one discipline: only buy when the price is meaningfully below the value. That gap is called the margin of safety, a concept he inherited from his mentor Benjamin Graham, and it has become the single most important phrase in his investing vocabulary. The most powerful demonstration of this principle in Buffett's career came during the 2008 financial crisis, as Lehman Brothers collapsed and the global banking system teetered on the edge of complete failure. Wall Street descended into panic. Stocks were falling by 10, 20, 30% in days. Institutions were selling everything they could to raise cash. Rational analysis had been replaced entirely by survival instinct. Most investors were trying to get out of the market as fast as possible. Buffett was writing checks. He invested $5 billion in Goldman Sachs, securing preferred shares with a 10% annual dividend and warrants to purchase additional stock at a locked price. He invested $3 billion in General Electric. He made several other significant commitments during the same window. He wasn't being reckless. He wasn't gambling. He was doing precisely what his checklist instructs. He had found businesses he understood, with durable competitive advantages, run by capable management, and the market, in its panic, was offering them at prices that were irrationally below their intrinsic value. The margin of safety was enormous, so he bought. The returns on those investments were extraordinary, not because of luck, not because of genius, but because of patience. Buffett had spent years before the crisis identifying the businesses he would want to own. He knew exactly what they were worth. He just waited until the price came to him. That is the entire strategy. That is the whole game. This is the part of Buffett's checklist that receives almost no attention in mainstream personal finance content. Everyone wants to talk about which stocks to buy, which sectors are growing, which metrics to analyze. Very few people are willing to tell you the truth about what happens after you buy, because the truth is deeply uncomfortable. The truth is that the correct answer, most of the time, is to do absolutely nothing. Warren Buffett's average holding period for a core investment is not 1 year, not 5 years. It is, in his own words, forever. He bought Coca-Cola in 1988 and has never sold. He has held American Express through multiple crises and recoveries. He held Washington Post for decades. He held Wells Fargo through the 2008 financial crisis when it was losing billions. His default posture, once a position is established, is to sit still and allow the compounding to work. And the data on why this is the correct strategy is overwhelming. There is a study, often cited in behavioral finance circles, that examined the performance of investor accounts at Fidelity Investments across multiple market cycles. The researchers analyzed which types of accounts consistently generated the best long-term returns. The answer was startling. The top-performing accounts belonged to two groups of people: those who had forgotten they had the account and those who were dead. The accounts that received the least attention, the fewest interventions, the least trading, those accounts outperformed, not by a small margin. Significantly, this is not a coincidence. It reflects a fundamental truth about how compounding works and how human psychology destroys it. Research from Dalbar, a financial research firm that has tracked investor behavior for over 30 years, consistently shows that the average investor earns significantly less than the funds they invest in, not because they chose bad funds, but because they trade in and out of them at the wrong times. They sell during downturns because the fear becomes unbearable. They buy during rallies because the excitement becomes irresistible. And every transaction, every emotionally driven decision interrupts the compounding cycle and permanently reduces the long-term outcome. Buffett has a line he uses to explain this that is so simple it almost sounds like a joke. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. He means it literally. If your investment thesis depends on selling at the right moment, you don't have an investment thesis, you have a timing bet. And timing bets, in aggregate, lose. The psychological reason this rule is so hard to follow is that activity feels like progress. When the market drops and you are sitting still watching your portfolio decline, every instinct you have is screaming at you to do something, to sell, to hedge, to rebalance, to act. Doing nothing feels irresponsible. It feels passive. It feels like giving up. But for investors who have done their homework correctly, who have applied the first 4 rules with discipline in action, is not passive. It is the active expression of confidence in the process. It is the most powerful move available. The discipline to do nothing when everything around you is panicking is what separates the investors who merely survive from the ones who build generational wealth. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett lets bring the full checklist together. 5 rules. 5 questions. 70 years of proof that they work. Rule 1. Understand the business. Before you invest a single dollar, you must be able to explain clearly in plain language what this company does, how it makes money, what could hurt it, and what makes it hard to compete against. If you cannot do that, you are not investing, you are speculating. Rule 2. Find the moat. A great business is not just a profitable business today. It is a business with a structural advantage that will keep it profitable tomorrow, next year, and a decade from now. Brand power, switching costs, cost advantages, network effects. Look for at least one of these and be honest with yourself about whether it is real and durable or fragile and temporary. Rule 3. Trust the management. You are not just buying a balance sheet, you are buying into the judgment, the character, and the decision-making of the people running the company. Read their letters. Watch their capital allocation. Check whether they own meaningful amounts of stock. And ask yourself honestly, would I trust this person with my money? Rule 4. Buy at the right price. Even the greatest business in the world is a poor investment at the wrong price. Understand the difference between what the market is charging and what the business is genuinely worth. Wait for a margin of safety. Be patient. Let the price come to you. Rule 5. Then do almost nothing. Once you have applied the first 4 rules with discipline, the hardest and most important thing you can do is let the compounding work. Do not trade. Do not react to headlines. Do not let short-term fear interrupt a long-term thesis. The goal is not to be active. The goal is to be right and then to be still. Here is the truth that ties all of this together, the truth that Buffett himself has pointed to in various forms throughout his entire career. He did not become the greatest investor of the 20th century because he was the most intelligent person in the room. In an industry populated by some of the sharpest analytical minds on the planet, raw intelligence is cheap. He became what he became because he was the most disciplined person in the room every single day, for 70 years, without exception. He did not abandon the checklist when the internet boom made it look outdated. He did not abandon it when the financial crisis made it look dangerous. He did not abandon it when the market roared and everyone around him was making money faster than he was. He ran the same 5 questions, applied the same 5 filters, and waited for the same margin of safety year after year after year. The checklist did not change. The world changed around it. And the world always came back to confirming that the checklist was right. That is the part most people are not willing to hear, because it removes every excuse. The checklist is available, the framework is public. The stories, the letters, the case studies, they are all out there. What stands between most investors and the results Buffett has achieved is not information. It is the willingness to follow a disciplined process when it is uncomfortable, to be patient when patience feels unbearable, and to trust a system more than you trust your own fear. The checklist is not the secret. Using it and refusing to abandon it when the market gets loud, that is the secret, and that decision is yours to make.